Well, howdy there, folks. Welcome into this three-piece, 3 videos up here for me to react to. First one up here, rates have peaked, says Stephanie Link. Want to hear what she has to say, why she feels rates have peaked, and what does that mean? Like, where should you put your money in an environment where rates have peaked? So we'll react to that one from an hour ago. Then this one just came out 14 minutes ago. Piper Sandler says, buy retail. Ooh, that's an intriguing one. So looking forward to react to that one and give my opinions and perspectives. And then this last one, the head of the private wealth management division of Goldman Sachs, on her views on the market, stocks, opportunities, and things like that. So appreciate everybody joining me as always. Thanks so much for being here, folks. Thank you for being subscribed. New all-time high subscribers in the history of the channel. I appreciate each and every one of you. And after I release this video, I'll be hopping on Twitch for the live stream. A lot of earnings coming after the bell here today. So if you want to join me over there, then that will be the pinned comment down there. Alrighty, guys, let's get into this.
And we've been on this incredible run, right? NASDAQ's trying for 9 in a row. The Dow and S&P are trying for 8 in a row. You got yield stuff mostly lower. So tech has been on a tear. And then I look today and I see you bought more Alphabet and Meta. I said we had interesting moves. Let's start there.
Wow. Okay. Well, yeah, first and foremost, I think that rates have peaked. And the numbers last week really prove that. The unit labor cost down, lowest level since the end of 22, productivity highest in 3 years. If I think that rates have peaked and we are going to see a slowdown in the economy and inflation has peaked, I think you want to own more growth. I think you want to own more technology. This is really a trade, though, Scott, into the end of the year. We're going to have to reassess 2024 as we get the data. But I think you are going to have people chase. You've been talking about this for the last 6 months. And I would say, yeah, I'm chasing, but I actually started buying Alphabet when it fell 10% on the news, on the earnings report, and which I thought was actually very good. They grew earnings at 46% year over year and revenues at up 11% year over year. And 80% of their business, advertising, grew 9.4% and accelerated for the 3rd straight quarter. I know we got all upset about cloud, but I'm not going to get upset with 23% year-over-year growth in cloud for them. It wasn't as great as some of their peers. Fine, I'll take it. And
so you want me to show you something that if you are of the belief that rates have peaked, there's something that's going to do very well if rates have peaked and they're going down, okay? And let me show you this instrument right now. And it's certainly not Dish Network stock. That's one thing I can tell you for dang sure. It is this guy right here, TLT, which has been in an unbelievably vicious downtrend since, basically where it peaked out summer of 2020. So well over, oh gosh, that's over 3 years ago now. I mean, my goodness, that's insane, right? But check this out. This is just here recently, with kind of rates kind of topping out, and look at the move in TLT just so far, right? So naturally, if we're in a situation where rates have peaked, they start going down and down and down, we should see the TLT pick up and up in that sort of scenario. So just kind of something to keep in mind. I have no position on TLT. I'm not really interested. I just feel like there's a better place for my money. But naturally, if you were to tell me rates going to keep going down, like TLT is going to likely go up and up substantially in that sort of environment.
The stock was weak, but I like the risk reward. So the fundamentals to me were quite strong. Meta, we've talked about ad nauseum. I have owned it. I was trimming it because it had such a nice run. But I mean, in retrospect, I really regret doing that because the fundamentals, too, are so strong. Right? Yes. They just put up a double-digit total revenue growth of 23%, and they've got a great product cycle story and the best operating margins in 2 years. So I feel comfortable buying these companies because the fundamentals are strong. We're going to talk about another one where the fundamentals weren't so strong that I've been adding to as well in cybersecurity, but I feel really good about continuing to build up these positions, again, because more macro plus the micro. I like the combination.
Joe, you want to be in tech, you want to be in growth. Those words today, mark them down in stone from Stephanie Link, because when she says that, you better stand up and listen.
But you know what I don't like, though, about what she just said? She talks about, Google this, Meta that, right? And how strong their fundamentals are. Yet she's talking about holding these as trades into the year end. Like, what? Like if you're trying to trade, I don't think the best thing you should be looking at is fundamentals of companies. If you're trying to trade on stocks, if you're trying to trade in and out of these stocks, a lot of it comes down to momentum, what you think is going to ultimately happen with rates, right? What you think the positioning is going to be for the next few months and things like that. So the fundamental side, it's super important if you're like me and you're looking out several years, right? But if you're somebody that's trying to trade, I mean, it's just like, there's a lot of much more important things to try to judge short term, and it's all a tough game. Trust me on that.
End of the year, Scott. We can reassess next year.
And that's perfectly fine, because I think many want to know what the next 6 weeks
from now
are going to hold for the major averages. Month to date, why does Steph say be in tech, buy growth? Apple's up 6% month to date. Microsoft all-time high. Alphabet. Now the stocks are pulling back a little bit today. It's a bit of a mixed picture throughout the NASDAQ as it goes for its streak. Again, month to date, Alphabet, Steph's Alphabet up 6%, Amazon up 7%, Nvidia's back up 13%, Meta's up 6%, Tesla is up 11%. Dan Ives says fundamentals are holding up like a rock of Gibraltar. Tom Lee, excuse me, stocks can drift higher by the cues.
The concentrated performance year to date from Megacap will go parabolic by the end of the year.
Whoa.
If you think about the reasoning why.
Whoa. Hold your horses. That's a big prediction. He says these stocks are going to go parabolic by the end of the year. Whoa, okay. Whoa.
As a portfolio manager, strategically, you review your options and you say to yourself, tax loss harvesting occurs where? Everywhere except the mega caps. Buybacks over the next several weeks. Where will buyback intentions be the strongest? In the mega caps. Where is there the lack of sensitivity to the cost of capital in the mega caps? So collectively as a portfolio...
And also, if you're trying to play catch up because you're underperforming the market significantly, right, which is probably a ton of these fund managers, they're probably way underperforming the market, which the market's just saying, that's SP 500. Where do you want to play the catch up play? You're going to play it in mega cap tech. There's a lot of factors going into year end here.
You say to yourself as you move toward the end of the year, if I have not been there, I need to be there to try and catch up performance as much as I possibly can. And please, that's not what I'm suggesting that you're doing, because you've been there and you've been there for Meta very early. But for the rest, the majority of the portfolio management community, they need to be there. And these are the stocks that are going to give them the most significant weighting to try and recapture performance.
Yep, 100% to try to recapture performance. He made some great points there at the end. That gentleman is Joe Terranova. Already Piper Sandler says buy retail. Retail. I own several different retail stocks. Let me see how many retail stocks I really own. I own several of these babies. Let's see. Retail. So, let's see. I own the Planet. The Planet you can consider a retailer. I own... where's more retailers? JWN Nordstrom, that's a retailer. Amazon's a lot more than a retailer, but we can call them a retailer as well. Okay. Let's see what else. Target, retailer. Revolve is like we can call it a online retailer. Okay. And Foot Locker, definitely a retailer. WBA, retailer, but very specialized, obviously, retail there. So I own several stocks that would be considered more retail-related plays.
Says buy retail, right? They say the XRT has reversed a 3-month downtrend, add to positions on a topside breakout, discretionary above its 50-day moving average for the first time since September. A whole bunch of retailers report next week. Depot, Target, Advance Auto Parts, TJX, Walmart, Macy's, Bath Body Works, Gap, Ross Stores, BJ's.
Gutsy call, and I'm not just saying that because I agree with it. We're going to do another call later that I also think is gutsy that I disagree with, but I agree with this, all right? And Steph and I have talked earlier about the strength of the consumer, where jobless claims are. Next week, we're going to get another look at retail sales, this time for October, after all the student loan payments have gone on. So next week is pretty important, both on the macro and specific to the company. Look, the consumer is employed. The consumer is employed, and inflation is coming down. Now, consumer sentiment stinks. It is really lousy. And it's really lousy because all of the news that's out there. But bottom line is the consumer has disposable income. With inflation coming down, they are spending it. And philosophically, I don't care whether it's the right thing to do or not. That's what Americans do. They consume.
All right, Steph, you own.
So, important points. The one thing I would say, be very careful. Be very, very careful into year end when it comes to expecting these stocks to perform into year end. Because remember, a lot of these stocks have been hit significantly. So a lot of them are still going to probably have some tax loss harvesting coming over this next 7 weeks. And so that is just something to kind of keep in mind. Do I like retail in 2024? I do. Because the way I kind of think about retail, a lot of these stocks have already been just absolutely obliterated and hammered, right? And we're not going to still see big ticket purchases really go up. So if you're talking about people spending, they're really still not going to be going out there and buying the new house and new car in 24 likely, and a bunch of new furniture. They're going to be likely spending on smaller ticket purchases, right? A new pair of shoes, a new pair of jeans or whatever, right? And so I think that could be ultimately a benefit in for stocks that are just absolutely obliterated. And I think they're going to see rotation of money into those in 2024. I could see, retail having a decent year, maybe stronger in the back half, though.
Price target cut today to 174 from 184, and that is at UBS, which they still reiterate the buy.
And this has been a miserable stock, but I think the valuation discounts a lot of bad news at 14 times forward estimates. The historical average is at 17 times. Of course, if you believe in the estimates, but I'll look at enterprise value. It's actually below pre-pandemic levels. That's crazy to me for a company of this quality, this size, the market share that they're taking across the board. The key to this report will be margins. Can they be profitable in a challenging top-line environment? Comps are going to be down -5, -6, but can they see another quarter, would be the third quarter in a row, of operating margin expansion? That would give me confidence that their turnaround is actually working, and that has to do with inventories.
Joe, do we agree with this call by Piper Sandler today to buy retail stocks? RSI climbed bullish. We said back above the 50-day. You have a number of stocks next week. You own Costco, Darden, Lulu, Ross, TJX.
And Burlington as well. And Burlington, Ross, and TJX are in the bottom quartile when I look at the 16 consumer discretionary names that we own in the ETF, and when I look at the performance, the strength is coming in the names that we own. From e-commerce, Mercado Libre is the best performer that we have in consumer discretionary. It's coming through travel, Expedia, Airbnb, Marriott, Booking Holdings. So it's not really coming from these names. I respect and understand Stephanie's view on Target. What I'm trying to disseminate is why there's such weakness in Target when there's such strength in Walmart. I think that's a fundamental peculiarity that I think has to be uncovered before I could say, okay.
Because the consumer is the most price sensitive, certainly in many, many decades, right? I mean, just think about it logically. The consumer, I mean, we haven't seen this level of inflation since the 1970s, right? And so naturally, that's pretty much the best possible scenario for a company like Walmart, right? Because Walmart's always going to beat everybody on price. So if you're very price sensitive, you're going to go to Walmart, right? If you're in a tight spot. I mean, I used to make hardly any money when I was first coming up in the financial game. I used to make $8 an hour. Guess where I shopped? Walmart. Even when I first started working at Quick Trip, started making $40K, $50K a year, I shopped at Walmart. Walmart every single week. You know why? Because Walmart had the better pricing. And so, and as I built my wealth over the years, I stopped shopping at Walmart. It's naturally what happens. So if you're in a tougher environment, Walmart's going to outperform. If things get better in the economy, consumer confidence improves, somebody like a Target's going to outperform a Walmart. It's a pretty simple game in regards to those two stocks.
And buy Target.
It's mixed. They have more consumables than Target. Target is more discretionary, and that's been known for a long time. That's been where you want to be. So you've been right. I've been wrong. I think eventually they're going to change their mix to a little bit more of a balance between consumables and discretionary. And by the way, I think they're doing a phenomenal job in discretionary because they have all that private label that's really doing remarkably well.
When you say consumables, you talking about groceries?
Yeah. Exactly right. It's like 70% at Walmart, 75% at Walmart. It's only about 40 to 45% at Target. And so you're seeing definitely people flocking on the consumable side to Walmart, which is why Costco's also doing quite well.
Joe, you sound reasonably negative about the consumer or discretionary stocks, but yet you're overweight that in the ETF. And momentum, which makes a difference for you, obviously, the XRT's down 8% in 3 months. So it had a downdraft over a period of time where you could have rebalanced out of some of these names. You did not. Why?
Well, that's not true. We sold out of 6 names. So
retail ones?
We pulled out, we got out of Chewy, we got out of Nike, we got out of Ulta Beauty. We were sellers of those names. We were out of Yum China
why
as well.
Are you still over? I should have phrased the question better, and I apologize. Why are you still overweight? Retail.
So, man, those are tough sells. I mean, selling Ulta and selling Nike. So, I mean, they're talking about 2 of the greatest companies in the world. Like, those are tough sells. I'm like, whew.
Excuse me. We are overweight travel. We're overweight e-commerce. We're overweight home builders, D.R. Horton, Lennar, and we are overweight apparel, specialty apparel in the form of Lulu, and we also have quick serve through Chipotle. So we only have 3 names that are pure retail, and as I said with my initial comments, they are at the bottom quartile of performance.
Yeah, so D.R. Horton had really interesting numbers. D.R. Horton's about the biggest home builder out there, market cap-wise, or if they're not the biggest, they're very close to the biggest. And I saw something interesting when it comes to D.R. Horton. 2 things interesting. One is their backlog is going down. But the second thing is they're still doing pretty okay when it comes to D.R. Horton, or I should say pretty good. And the reason being is D.R. Horton sells like the most affordable homes pretty much of any of the home builders out there. They usually sell the cheapest homes. Their homes are on the average price in the 300s. Versus many of the other home builders, their average homes are either in the 400s, 500s, 600s, or in the Toll Brothers case, like up near $1 million or around $1 million for average home sale. And so somebody like a D.R. Horton is doing okay because people are looking for affordable homes, affordable meaning under 400K, and D.R. Horton's building those types of homes, right? All right, next one up here. Now is the time to stay invested in equities. This is the head of private wealth management for Goldman Sachs.
Pace for their longest winning streak in about 2 years. My next guest says now's the time to stay invested in equities while also adding exposure to fixed income. Joining me now, Post 9, Sarah Nason-Tarajano of Goldman Sachs Private Wealth. Welcome. It's good to see you.
Thanks so much for having me.
All right, so you're positive on the markets because a lot of people are so negative. What are they missing?
Listen, I am positive on the markets. Obviously, we've got a lot going on from a geopolitical perspective, from a rate perspective. But, I run the global family office business at Goldman Sachs. And I think one thing to keep in mind is that we're working with clients who are long-term investors. Mm-hmm. We're not, working with clients who are answering to a board of directors or thinking.
And answering to clients that are high net worth. High net worth.
Sort of daily market, NAV moves. And therefore, if you can really think long term about the market, we were advising clients on this, kind of post-summer 10% correction. Anytime you see a correction close to 10% is when you want to be getting longer, especially when you are a long-term holder of equities, which our family office and private clients typically are.
The flip side of that is now that we've had this big rally in the span of a week, so how does that factor into the way I should be thinking? We've spoken.
These people have a very intelligent. You can understand why they got into Goldman Sachs private wealth. You got to have so much money to get in there, man. So much damn money. But you got to think to yourself, like, what's the perspective, right? The perspective is genius. We're going to own more of the world over time. And it doesn't matter what we're going through in cycles. We're going to own more of the world. We're going to own more of the world. We're going to own more of the world, right? And that's the perspective of those people in thinking even around generational wealth, right? Thinking about their money when they're not here anymore, when they're dead, right? And where does it go, whether it's to the family line or whether it be to charities or all those different things, right? Very, very long-term investors in just understanding the economies will grow over time. We will be much more prosperous as a world in 20 years from now than we are today, and in 10 years from now than we are today, and in 30 years than we are today. I mean, can you imagine the level of wealth the world's going to have 100 years from now? It's going to make today look like a joke. You're going to understand, even if you're a person that is, let's call it, somebody in poverty, there's an argument to be made that you could be living better than somebody lived, 100 or 200 years ago, in terms of what you have access to versus what those people had access to. Like literally, you could be somebody in the middle class today, and you live wealthier than the person that had the most money in the world 150 years ago. Like what they had access to, their level of healthcare, their level of everything compared to what you have access to, it's night and day difference. Now imagine 100 years from now, they're going to be the rich people of 100 years from now. And we're going to look at the rich people of today and be like, wow, their life sucked, man. They didn't have much going on. And the same thing with the folks in the middle class and things like that. So people forget that, right? And they forget all the technology developments and how much better life can be nowadays versus 100 years ago, 200 years ago, 300 years ago. People always like to think like in a negative perspective about like times are worse now. No, believe me. If you went and lived in the prior periods, you'd be like, get me the hell out of this thing, okay? Get me the hell out of this thing. Like, what? We don't have this, we don't have this, we don't have have this, we don't have this, I'm out. So trust me on that.
With your colleague Tony Pasquarello on numerous occasions, most recently suggested the path of least resistance was higher.
If you told me I could be the richest person in the world 100 years ago, but I had to switch from today, hell no, I wouldn't switch. Not even 50 years ago. You could tell me I could be the richest person in the world 50 years ago. Would I switch? Hell no. Like, I don't want to live in 50 years ago. I don't want to live in the 1970s. Come on, man.
Now what? We've had this pretty substantial move.
Yeah, look, I still think you've got the seasonality impact of November and December. We see corporate buybacks, $5 billion a day of corporate buybacks up until December 8th. And then, we've got potentially a perfect storm. I don't want to say it, thinking about, a soft landing. If we think the Fed is done, which I do, that's positive for equities, clearly. If we think inflation can stay under control, which I tend to think it can. If we think the economic data is strong, but not so strong, and, payroll and wages are sort of at the right place to keep things at a moderate growth level, then I think that positions us really well for equities.
Would you then say you want to move broadly from just mega cap tech? I mean, if you are, inflation is going to be lower than maybe people think, economy is going to still be more resilient than people think. Does that make the case for some of these other cyclical areas or not? You're kind of shaking your head like you're not willing to kind of go that far yet.
I'm probably not willing to go that far yet. And I think it's more for us about just staying long index exposure in U.S. equities and really focusing, if you're going to do single stock work, on companies with strong balance sheet, durable earnings growth, stable margins. You have to keep in mind that even though, we don't think the Fed is going to hike again, we are in a rates higher for longer market, and we have to think about
that part right there was extremely important because it lets you know somebody that's the head of private wealth management at Goldman Sachs, how they think about the type of companies they want to invest in. Like, what type of qualities are they looking for in companies, right?
For us, about just staying long index exposure in U.S. equities and really focusing, if you're going to do single stock work, on companies with strong balance sheet.
Strong balance sheet.
Durable earnings growth.
Earnings
margins.
Growth.
You have to keep in mind that
earnings growth and stable margins. Those are the three main components that somebody like that is looking for in a company, right? So just understand that's why those sorts of companies perform so phenomenal over time, even if sometimes they look overvalued on a forward P basis. If you have stable margins, you have, EPS that's pretty consistently going up, and you got a strong balance sheet, people don't mind paying up for that. Even if they got to pay a forward P that's well above the market, they say, I want quality, and that's true quality at the end of the day, right?
No, we don't think the Fed is going to hike again. We are in a rates higher for longer market, and we have to think about that impact on equities. We still favor U.S. equities, by the way. U.S. preeminence is a big theme for us. Our investment strategy group has had a fantastic call on that. I continue to have that view. But I also think we don't have to be quite as precise if you're talking about clients that hold stocks for years and sometimes decades and generations. So it's okay.
So she talks there about being, almost like overweight U.S. equities, right? Being heavy U.S. equities and not so interested international. And my view is I will focus more international investing when I see a lot more innovative companies that are going to kill it in other markets. And I just haven't seen that. What I see is even in the developing economies, I see the U.S. companies going in and then dominating in those markets. And I just don't see nearly enough innovation coming out of other countries. You could say China maybe has innovation, but no one wants to invest in Chinese stocks. That's a borderline scam in regards to that whole situation. So no one really wants to invest in Chinese stocks. Look at almost every single Chinese stock. Trash. Look at almost every single one, from the biggest big dogs of Alibaba all the way down to the Neos. All of them have been nothing but trash. A few of them pumped in the hype cycle of 2020, 2021, and all of them straight down. And all of them are basically lower than where they went IPO at. Think about that for a moment. Even if they've been public 5, 10, 15 years, it doesn't matter. And so there's not a lot of innovation really happening in other countries. Europe, it's just not happening, man. And I don't see it happening anytime soon. India is going to be a huge growing market. It's going to become massive, but I think a lot of the U.S. companies are going to be the ones to benefit the most from that, just to be quite frank, other than the people that live in India. And as wealth grows over there over the next 20 to 30 years, which is going to be a very exciting time. But yeah, man, there's just not a lot happening outside the United States. So if you want to invest, you got to invest in U.S. companies. They're the ones that really run the world, and there's no signs that they're going to stop running the world, because it's just not getting beat by anybody international. If anything, they're becoming even more dominant, which is interesting.
Don't get the timing perfect.
But you're not willing to go say that, the Fed, having been our foe, so to speak, by this regime they've been on, is not yet your friend. They're not going to cut, because a lot of times you could say, well, we think the Fed's not only done, but they're going to want to get ahead of that.
Yeah.
The Fed, is the game in town that matters most. Higher for longer still means it could be a challenge with rates elevated.
Yeah, look, I think, not quite our friend, but not our enemy either, is how I would put it. And I think what I would say about that is, our house view, which I agree with, is we're going to see cuts in Q4 2004. And so actually an interesting topic. We've been having a lot of conversations.
Did you hear that house view? I love the way they term everything at Goldman Sachs. It's such a Goldman Sachs, they might be getting their mojo back. They might be getting it back.
Clients about fixed income. As you can imagine, we have been super short duration. I mean, it's hard to compete with treasuries 6 months at 5.5%. But if you have the view that the Fed is not going to continue to hike, and that actually we're going to cut in Q4 24, then you want to start thinking about extending your duration a little bit. And 3 to 5 years is where we sort of think that sweet spot is with clients. And one nice thing about our client base, particularly family offices, these guys are long private assets, they're long equity portfolios, and portfolios that spit out cash dividends. So you don't have to rebalance to allocate new money. And that's, kind of a lot of freedom to take that new capital and think about adding a little duration to the portfolio.
Also,
that's something that doesn't get talked about enough in regards to dividend investing specifically, right? Think about it like this. You got a big dividend portfolio, which, these people and these family offices have $50 million, $100 million, hundreds of millions of dollars, sometimes billions of dollars, right? And you own a bunch of different dividend stocks, and those dividend stocks are paying you out every 3 months, likely hundreds of thousands of dollars, if not millions of dollars of capital every 3 months. Every 3 months. And so all of a sudden you have hundreds of thousands of dollars of capital, or millions of dollars of capital, or depending upon how much you might have tens of millions of dollars of capital to then deploy every 3 months. Think about that for a moment, right? And that's one of the beauties of dividend investing that I think many times is probably a little overlooked.
Investors who are
the super high net worth individuals do not overlook it.
Billionaire investors, either family office money or hedge funds, private credit. Is hot.
It's a big theme. And, one thing to keep in mind, so we published a global family office survey in 2023. We did the same survey in 21. Our clients are historically under-allocated to private credit. They have a 3% allocation to private credit. This is not surprising. There are a couple factors. Nice. We come out of an incredibly low interest rate environment for the last decade.
Yeah, why not be in stocks?
Right. But U.S. taxpayers also have to pay ordinary income in private credit. But today, I actually think private credit is really interesting, because you're looking at, double-digit returns, and you've got a client base that is quite overweight equities, private equity alternatives. I think there's a real space in the portfolio for private credit, particularly in direct lending. Those double-digit returns are still interesting after tax. You're higher on the cap stack. You typically have better covenants. There's a lot of things that make private credit interesting.
Talked a lot about that yesterday.
Yeah, we'll see. Sometimes that private credit money doesn't come back, right? All right, appreciate everybody joining me as always. Thanks so much, folks. Thank you for being subscribed. New all-time high subscribers. I'm about to hop on Twitch live stream. We got a bunch of earnings coming out after the bell. Going to live stream that. If you want access, it's free access. You can check out pinned comment down there. And then if you're looking to apply to join my private group this week, then check out the description area down there. You can fill out an application. We can see if we can get you in there a little later this week. Much love as always, and have a great day.